What is going on, everybody? Kind of wanted to hop on here real quick because I've seen a lot of false information online as far as like why selling calls is more risky than trading options, like zero DTE. And while everyone likes zero DTE, right, the feel of you trading zero DTE, a lot of the times you're going to lose when you're trading zero DTE because, yeah, you might get 20, 40, 60% profits, but you're usually going to lose 80 to 100% of every single trade you take. Um, yeah, it's an up and down roller coaster, but it's not something that I would recommend someone to actually trade consistently to make money. I mean, I used to trade them all the time. I haven't touched them for probably a year. Now, I made a little bit of money doing it, but the amount of times that you would go in and for every like one trade you lose, like, you got to win like two or three. It just sometimes even more. So, it's just not something that you should do if you really want to make consistent income. So what's the problem with zero DTE or any option in general? So the problem with options, like for at least my strategy, I always go based off the numerical value when I'm trading right at a level. So when you go on options, you have 17 different things working against you, whether it's theta, time decay, premium, volume, all that different stuff working against you, right? And it's just, I'm sure you've all been on this kind of trade too, but I've been right many times where the stock might move up 3 to 5% in a day. That's a huge move. But on the way to that 3% up for the day, it'll go up, kind of come back down. It'll be back at neutral where you bought in, and it goes up. And by the time you look at that, you could be down 10, 15% on your options, and you're like, well, what's going on here? I'm picking the right directions. What's all that stuff working against you in an options? So that's why, unless you really know what you're doing, even if you know what you're doing on the wrong day, if everything doesn't line up, you can lose money. And that's why day trading, especially zero DTE, isn't the best. So what I personally do, at least what I've done over the last year or two, I've kind of switched over to the futures market and I trade the numerical values, right? Same thing as trading stocks. And then what do I do with my options? Well, I now sell options and then I also do swing trading, leaps. Leaps are one of my favorite. And I have a whole system breakdown in that, but kind of give insights on what I'm doing. And if you happen to want to join a community, feel free to go head down below. Obviously you can copy what I'm doing, copy what some other of my friends are doing. But, in reality, this video should be all unique. If you want to join the server, it's a lot of like-minded people. That's what we kind of do. So why is selling calls or selling options safer than just trading options every day? Well, first you got to start with your perspective. So what is your perspective on the market? What is your plan? Is your plan to, invest full time? Is it to invest and make enough money to, fund another business? Is it just to make some side income for a vacation or just to have in your savings account or in your trading account? You know, that's the first thing you have to answer. Now, once you have an idea on that, then you can kind of make the next steps and decide how much you want to go into it and how risky you want to be. So, as you can see on the right side of my screen here, I'm in a lot of HIMS and TSLL. And if you know anything about the HIMS market or the Tesla stock market, you obviously know that these are leveraged. So HIMS, that's a two times leverage. TSLL, it's a two times leverage. There's a lot of volume in those stocks. So while yes, I am trading them, I'm not only am I selling and getting premium, I'm also getting value on it. So if you look here, I'm in a 1017 expiration, which is this week. Look here at my date sold 10/7, so 3 days ago, right? I'm not really worried about the today's return or the total return or the market value. So you can see I collected, 1,500, or actually it looks like 1,200. So so as you can see, I collected 1,200 in premium, right? And how do you get that? Well, it says average credit times 10. So obviously, take 10 times that, that's $1,200. That's what I collected because this is 120 times 10. So I collected $1,200. Now, as long as the stock, you can see right here, 1,200. And this is the 25 call. So on 1017, as long as HIMS is below $25, I collect that full 1,200 and I keep my shares. Now, if you're in a stock like this, what I actually would like to happen is at $25, I'm going to keep my 1,200 and it's going to sell me at $25. Now, here's the thing about $25 on HIMS. So if you look at HIMS, it doesn't very often get up to 25, and at least recently, like right, like that's around that zone. But I would actually prefer to kind of push up above 25 here and actually sell me out, because then what I'm going to do is I keep kind of getting back in around the 20 level. So you can see multiple times I've swagged that. So if I'm in 1,000 shares and I'm going from 20 to 25, that's $5,000 in like a week that I'm doing off of 1,000 shares, plus the 1,200 that I'm selling. So I'm really making $6,200 just this week if that happens for me. That's good money in a week to risk, 1,000 shares. And if we go to Hims, right? Like, let's just see what Hims is at right now. You buy 1,000 shares, buy order, limit order. Let's just say at 20, because that's where I'm getting it at. You're at $20,000. Now, obviously, right now we're at 23.28, right? So that's what the shares are worth right now. At the time of when I did that, they were worth on the 7th around probably $22 when I sold that. So again, that's $22,000. And if I get sold out at 25, I'm making that's $3,000 difference just from not only am I selling my shares then, but I'm also selling that premium. Now, obviously, like I said, my average is way lower than that. My average is 18.95 a share. So, I bought these shares probably back a good while ago. Yeah, so back mid-September, and I'm just kind of collecting the premium. So every single, month, or I usually do it by the week or every 2 weeks. So every 2 weeks, I'm selling these contracts, and I'm just kind of placing it just above where I think it could go. Because while I would like to get out at 25, I don't have a problem holding these shares too and just collecting that 1,200 a week passive. So if you think about it, I'm collecting what, $1,200 a week, $1,200 almost every week and a half. So, since I bought them shares, I've collected like 1,200 about 3 times. And that's just doing nothing. That's just holding my shares and doing nothing. You see what I mean? Like, that is so much easier to look at it once. You could even look at it once a month. You could mess around with your stocks once a month. You don't have to be in there every single day trading. You don't have to be in there zero DTE, losing your trades, winning a trade, winning two to equal one loss, and doing all this and all that. It doesn't make sense. So again, if you want a bigger breakdown of this, I can do this. But I kind of just, this is kind of a video out there for people that already kind of understand the real strategy. If you don't really understand the real strategy that much, let me know, and I'll make a really in-depth video of like both sides of it, selling calls and selling puts and buying and all that. But this is just kind of the video. Like, obviously, if you clicked on this video, you probably already know about selling calls, because why would you click on the video if you didn't? But you're also, like I said, time decay works for you. You're using covered calls to stay consistent, right? If you're already, if in this part of selling calls, you already own 100 shares, so it's not too bad. So again, why is it safer than day trading options? So you don't have to trade stocks every single day. Again, right? You're not glued to the screen, not hoping to catch the momentum like you did before it eats your premium if you're already in a options contract. And you're really maxing your risk and loss ratio, right? Like, obviously you own the shares, right? So you're going to lose shares on that. But even if the shares go down, you already collected your premium. And if the shares go up, well, you get out at your price that you were at. Or if it doesn't touch that level, you're still keeping the premium. Also, why is selling calls my favorite, at least recently? Because not only that, but it helps you set up a plan, right? It's a rules-based strategy. If you stick to your rules, you don't have to be emotional, don't have to be impulsive with buying a bunch of stocks. It's easy to stick to. If you can't stick to this, you're not going to be profitable trading options. So obviously, this could be a good starter. And in reality, if you have at least a couple grand, you can do this with smaller stocks. Like, it's going to make it valuable to kind of grow. And then you really learn and can tone your strategy and kind of figure out what works for you. Every stock is different. Personally, I don't do Apple. A lot of people that I know love trading Apple. But it just, to me, it's not really my favorite. What's really good is TSLL. So let's just look here at TSLL. So we're looking at it and we're like, okay, so just looking at this chart, I'll tell you, $23 is a really good top. So let's just go down. Look, right here. 22 calls, 10 sells at 22. So right now, the stock is at $20, 20.21. I am in it right now, 10, which is 1,000 shares. So every contract is 100 shares. 10 contracts at 1 point, about, let's just round up 1.6. So that's almost it's $1,590 that I just made premium on that. And again, remember what happens. If the stock stays below 22 on closing or before closing, I keep that full premium and my shares. If it goes above 22, I'm going to gain that $2 from where the stock is at now, plus keep that $1,600 in premium. So 1,000 shares, that's $2,000, plus I'm keeping 1,600. So I'm almost doubling my profit if the stock hits $22 on TSLL. Now, I would recommend, if you are someone that is starting out with a smaller account, TSLL is probably where I would start. I mean, I wouldn't, well, I'll say this. I wouldn't start there first. I would start with other stocks just until you understand the strategy. Once you understand the strategy, the amount of, I would say the cost per profit on TSLL is where it's going to be. But again, that means you have to hold it and it's pretty volatile. So you have to be able to understand that. So again, go November 7th, stock price right now is $20. Now, if you wanted to go say, well, okay, well, I want to sell to get into TSLL, where do you think TSLL is going to be? Okay, well, I'm going to say to myself, you know what? In 2 weeks, I think, or 1 week, I think the stock is going to be 19 and a half. I'm going to buy this. I'm going to get $85. I'm going to get in, let's say, 100 shares. Let's say you have money. You have $2,000 in your account. If you have $2,000, this could be a really good play. And I'm not telling you to get in this one. I'm not even looking at the chart if that's a good buy-in. This is all hypothetical. Hypothetically speaking, if you look at the chart right now on TSLL, okay, yep, so see, 19 and a half. 19 and a half is probably, a good buy-in spot. You could probably do 19 or lower, but your chance of getting filled, plus your premium's less, right? So let's just say, hypothetically speaking, this is an okay play to get in right now. Get in for $2,000. You got $85 of premium, so you're really getting in for like 1,800 and high 1800s, almost close to 1900. It's really like 1880, 1870. So I'm in for $1,880, right? So now, pretend we're already in the stock. We're in at 1950, right? So we got filled. We're in at $19.50 average per stock. We're really a little bit lower because we got filled. We got that $85 in, premium. So the way you can look at it is either I profit and pocket that $85, or you can calculate it in your average share cost. I usually look at it and just say I want to profit, because if I'm at 19 and a half, I'm not looking to sell my shares at 19 and a half. Right? I'm gonna make profit on my shares, plus I want to collect the premium. So again, here we are. Now, obviously, I did this, a week ago. So in reality, we're gonna look 2 weeks out, because that's probably about the value of where I would be 2 weeks out. It's typically what I do in TSLL. So again, you're in at 19 and a half, right? Here's what I would probably do. Now, like I said, if I want to get in a stock, I usually do a week or less to get in, just because you collect a little bit of premium and you get the shares. Where you make the most money is when you already own the shares and you're selling the options, right? You're selling the call. So I'm going to look here at 22. So again, I'm in 100 shares, right? So if the stock goes from, if the stock goes from 1950 to 22, you're making $2.5 on 100. So that's 250 bucks, right? Plus, you're going to collect $130. Plus, you already collected that $85. So if you have an account for $2,000, right? $2,000, then you would walk away with $335.30 or so. It's what you would profit off of just under $1,900. So with $1,900 within 2 to 3 weeks, you're making $335. So that's a pretty good return. I mean, that's about that's about a 20% return on your money. So in 1 month, you can make in less than a month, in 2 to 3 weeks, you can make about 20% of your return just off of a TSLL. Now, while I do not recommend if you have a bigger account, you may be like, oh, that's 20% a month. That's great. That's not really where you want to be. You want to kind of scale out. Now, I'm not saying scale out into 27 different stocks. You probably want to pick, 5 to 7 good stocks, and you want them all not to be in the same sector. You could have two or three, you know, growth versus high risk and all that and different sectors. That's fine, but you don't want to do it all your eggs in one basket, right? So while 20%, that's a great account return on one thing. If you only have $2,000, that's a great return. That's fine. But if you have like an account that's like 10 grand, I would probably only risk, 40% of your account, $4,000. So like I would do two. So I'd basically make double. I'd make 650. My other 6 grand or so, I would put in other stocks and like two other ones probably. I would if I had 10 grand, I would put it between three stocks. Now when you get up to like six figures and even like a couple hundreds of thousands from doing this, that's where you can really start making money, and that's where you can really start putting some money around. And that's when you might do okay 5 or 10% in something like this, but the amount is going to return a huge risk reward ratio versus other stocks like Apple and American Airlines. So again, the bottom line, trading's options daily is like sprinting, right? High energy, high risk. The lifespan of you being profitable consistently is probably not there like it would be with this, right? I mean, this is like super easy and it's profitable over time, especially in bull markets. In bull markets, this is the best. Now, obviously, there's little tips and tricks which you know I can help with that. If you watch these videos or if you have questions, you know, my Discord's below. I have friends in there. Any of us can help you. Other people that know this strategy can help you. Um, and even then, if you want me to make more videos about this, make sure to comment below and just say, hey, can you explain this better? Can you make a video about more on the selling puts or selling calls? Can you explain it a little bit more in depth? Like I said, this isn't really to go too much in depth. It was just more or less kind of coming out there with my opinion on how I think this is safer than buying zero DTE options, because I've seen a lot of people out there complain and say, oh, the wheel strategy's not safe, it's not this, and options is better. In my opinion, this is safer than just selling options. And you may ask me, why do you think this is safer than beating the mark than options, right? Well, the thing is when you're selling options every day, you're trying to beat the market every day in the same day, right? So you're up and down and you're like, oh, I got to get in, then you want to get out, and then you want to get in, get out, and you're going to, the market's going to pick a direction sometimes it's up and down all day. So you're going to be in your options. So why do I think this is safer than buying options, right? So to me, you're not trying to beat the market every single day. When you're trading options, whether it's zero DTE, whether it's day trading, if you're day trading, every single day you're in and out of them options, right? If you're swing trading, probably every week you're trying, every month maybe, unless you're like, you know, doing leaps. Every day you're trying to beat the market. When you're doing this, you don't got to beat the market every day. You're using time and probability to become the market maker, essentially, right? Because you're the one owning the contracts now. So before, you were on the other side, you were buying the options. Now you're selling it to other people that were now in your shoes, right? So you're not having to worry about theta. You're not having to worry about all that other stuff. All you're worried about is what we just talked about in this video. Owning the shares, selling your shares, collecting premium. Those are the only three things you need to know about. So again, let's just take a look here, right? These are all my options that I've sold in the last week or so. And you can just see here, like the premium I'm collecting with just owning shares. Like that's essentially insane.